Good morning. Welcome to the Heritage Foundation and our Lewis Lehrman Auditorium. We, of course, take this opportunity each session to welcome those who join us as well on our heritage.org website. I would ask everyone here in-house if you'll make that final check that cell phones have been turned off. It's always appreciated. And, of course, we will post the program on the Heritage homepage for your future reference. And our internet viewers are always welcome to send questions or comments simply emailing us at speaker@heritage.org. Hosting today's program is Norbert Michel. Dr. Michel is a research fellow in financial regulations in our Thomas Rowe Institute for Economic Policy Studies. He studies and writes, obviously, on housing finance, including the reform of Fannie Mae and Freddie Mac, and focuses specifically on today's agenda item, too big to fail. He researches monetary policy and other issues related as well to the Federal Reserve. Before joining us here at Heritage, he was a tenured professor at Nicholls State University's College of Business. He had previously served as a tax policy analyst here at Heritage, as well as with a global energy company, Entergy. He holds his doctorate degree in financial economics from the University of New Orleans and earned his Bachelor of Business degree in financing economics from Loyola University. Please join me in welcoming Norbert. Norbert Michel.
Thank you, John. Good morning, everybody. Thank you for coming. We are hosting this event really because there's still actually a great deal of disagreement surrounding the events of the 2008 financial crisis. I think there's still some lack of agreement over, depending on who you ask, whether some of the TARP interventions were successful or to some extent even necessary. And there's certainly still a difference of opinion over whether Congress's response to those events really fixed anything. And of course, I'm talking about Dodd-Frank in particular, which is sort of a lightning rod on its own, I think. So a couple of weeks back, I kind of lucked out and saw a TV interview on Sunday Morning Futures, a show that I've never watched. Didn't even know it existed. I saw the chairman of UBS, Axel Weber, doing an interview. And at some point, he was asked to talk about some of the new regulatory changes that he was facing, both in the U.S. under Dodd-Frank and abroad, and to talk about how he thought his industry may change in the coming years. And I was kind of surprised when Axel said, and I quote, "So basically the whole new regulation for global systemic banks means that they have to carry an extra safety buffer on capital." And that was it. And I have heard other CEOs sort of minimize the impact of Dodd-Frank, which I would expect, given the regulatory capture that we have. But he seemed utterly dismissive. So I went back and dug up the unedited transcript, which included everything that didn't make it onto TV. And that one gave you a very different picture of what he really said, but all that kind of got cut out. He talked about the capital buffer. He talked about liquidity buffers. He talked about other, and I'm kind of using his language again, other safety buffers in many areas. And I have an idea of what he might have meant, but I'm not sure if that's why they edited, but that's what he said. He also noted that UBS has taken their capital ratio above the U.S. minimum, and that they are focused on becoming more resolvable, I assume in reference to some of the Dodd-Frank provisions. Also looking at whether they need to take the capital ratio even higher than they already have. And he said that they're taking a very close look at what they're actually good at and suggesting that they may look very different in 5 years from the way they operate right now. Now, that actually ended up being the more candid response I think that I've heard of any of these bank CEOs in relation to Dodd-Frank. So I thought that was interesting. Because the truth is that we have an extensive new set of financial rules and regulations both here and abroad, and the situation is actually somewhat convoluted. In the U.S., some of the members of Congress who actually voted on the Dodd-Frank bill can't really agree on exactly who some of these regulations apply to. So the situation is a bit of a mess, I think. Regardless of how those issues do get resolved, two of the main sources that give us these new rules and regulations are Titles 1 and 2 of Dodd-Frank. And that's kind of why we're here today. Title I created the Financial Stability Oversight Council and a process by where the Federal Reserve, is overseeing new heightened regulations for companies, both non-bank and banks. And then Title II, of course, sets up the Orderly Liquidation Authority, which allows federal regulators to seize a financial company with minimal judicial review and eventually shut it down. And there's a lot of disagreement over whether that's been a good change or a bad change. So we're here today to discuss these two particular aspects of Dodd-Frank, in particular the new capital requirements, or some things related to the new capital requirements, and orderly liquidation. Excuse me. I'll mention that outside we have a couple of papers. You can get these online, but if you want nice color copies, they're outside. A Heritage Foundation backgrounder that talks about capital requirements, and we also have Paul Kupiek's latest Wall Street Journal piece, which has some very interesting facts about the salaries of financial regulators. At least it was supposed to be outside. If not, you can definitely get them online. So our first panelist today is Charles Calamiris. He's the Henry Kaufman Professor of Financial Institutions at Columbia. He is also a research associate at the National Bureau of Economic Research, NBER. He's a member of the Shadow Financial Regulatory Committee, not ever to be confused with the obviously evil shadow banking community. He's a member of the Financial Economist Roundtable, also the coordinator of the Bank Performance and Economy Program at the FDIC's Center for Financial Research. Until 2007, he was the co-director of the AEI Financial Deregulation Project, and his research spans basically everything from basic banking and corporate finance to financial history and monetary economics. He's also got a new book out called Fragile by Design, The Political Origins of Banking Crises and Scarce Credit. So please welcome Charles Calamiris. You can say yours.
Whichever one you like.
I think I'll just sit here. Thanks very much. It's a pleasure to be here, and also a real pleasure and a privilege to be on a panel with all of these people who I know and respect very, very much. So the question that we're all supposed to talk about today is whether too big to fail remains a problem, and what Dodd-Frank did to deal with it, and what other things might make sense to do. So first, let me go down my list of the things that are at least worth mentioning that Dodd-Frank did. I won't mention all of them, but the most important ones. One of the most important things is the promise to liquidate banks, large banks, rather than bail them out. If that were a credible promise, it would have presumably some kinds of incentives that might constructive incentive consequences for banks too, so it wouldn't just prevent too big to fail as a taxpayer outcome, but it might actually prevent the riskiness that could produce systemic risk in the banking system. Unfortunately, and I think now there's a clear consensus across the board in terms of economists of all political tastes or affiliations, that the answer is that Title II of Dodd-Frank institutionalized the bailouts of too big to fail banks rather than avoiding them. It did that because it creates a political path of least resistance for politicians to bail out the large banks. And in fact, it even not only creates the actual process through which that would happen, but even funds it through a special new tax. Now, of course, the FDIC has said that that's not what they're going to do, or at least individuals at the FDIC have said that, but my view would be that that's not very credible, and that view is shared by most people. Another thing, and I'll talk more about this, capital requirements have been raised. Minimum capital ratio requirements on banks have been raised. The third major one, I would say, potentially, is for the large banks, stress tests are performed. So in addition to the sort of static or unstressed capital requirements that banks have to face, they also have to face stress tests. And as we know, Citibank recently, even though it passed, its quantitative stress test, meaning the one that has to do with numbers, that is in the worst-case scenario that the government ran Citibank through its quantitative stress test. Citibank passed above the 5% required capital ratio, but nonetheless, the government regulators decided that they didn't like the smell of Citibank, and so it didn't get to pay out dividends. By the way, we're going to have an event that Alex Pollack at the AEI and I are sponsoring on July 15th to talk about some concerns that come out of that regulatory process, and many other things relating to the FSOC. And the FSOC was also created to oversee and to be more sort of proactive about identifying risks in the financial system. I would say what we know from, I'll talk more about the stress test in a minute, what we know from the way regulators behave does not give us a lot of confidence to believe that the FSOC is going to, just by virtue of its existence, change much about credible discipline of too-big-to-fail banks when you need it, which is during bad economic times. Politicians and regulators have strong incentives to forbear during bad times, not to recognize losses in a very transparent or proactive way, and not to push, because pushing means credit contracts, means that other things happen that politicians and regulators don't like. So I don't take the FSOC as a very serious sort of commitment to reining in too big to fail either. More generally, now the one I haven't talked about, which now I'm going to address, is the capital requirement change. I would say that one of the strangest things about prudential regulation of banks, if you're used to thinking about corporations and not used to thinking about banks, because you're going to be it's much easier to get you to understand what's wrong if that's the case. Because if you're used to thinking about corporations and someone said, tell me how you'd figure out what's the health of a corporation. And if you said, well, I'm going to look at its book equity ratio, meaning the book value of its equity relative to the book value of its assets, people would just throw you out of the room. You'd get an F in my MBA class in corporate finance if that was your answer. Why? Well, because what we care about are the cash flows of corporations. And we want to know that their cash flows are going to be able to meet their debt obligation cash flows. We don't really care about the book value of their equity, which is an accounting residual of the difference between the book value of their assets and the book value of their debt. And that's really not relevant. If you were going to value Microsoft or think about Microsoft on the basis of book value of capital, it would be laughable. So why do we think that we can do that with banks, or that that's relevant to do? Well, back in the 19th century, that probably wasn't a bad thing to do, because banks' business was largely lending and deposit taking. And as long as you knew the value of the tangible assets of the bank, the loans, and you knew what the debts of the bank were, the book value of equity, if it were honestly being accounted for, would be a measure of the health of the bank, at least a reasonable, good first start. But that isn't what banks are anymore, and it certainly isn't what the largest banks are anymore. Their cash flows are driven by things that aren't even mentioned on the balance sheet. And so the first thing to note is capital really doesn't measure the health of banks anymore. Notice that this is also relevant not just for the capital ratios as a prudential tool, but although the stress tests go a little bit farther than the static capital ratios, they're still built on the same thing. They're looking at the capital ratios, and they're looking at how tangible assets, loans, perform under various stress scenarios. And they're also looking at things like how many loans would be drawn down. In other words, it's still what I would call balance sheet fetishism in terms of prudential regulation, which is really not what we need. So both the stress tests and the basic notion of the main prudential tool, which is capital ratios, is just not right. It's not what we should be doing. Now, what's even worse, of course, is that we know from the experience across many countries that when we get into trouble, even the tangible assets aren't recognizing losses in a very accurate way. And it's not just because it's difficult to do that, it's because the political incentives and the economic incentives are all against recognizing losses in a timely and full way. And so book value of capital is also not a very useful measure, even from the standpoint of looking at the tangible net worth, much less the real net worth of a bank, which includes its intangibles. Now, furthermore, it's not a very useful tool because what we care about is the risk of default. And even if you were back in a 19th century bank and you were really interested in using this capital measure, this book capital measure as your tool, you'd have to worry about its being commensurate with what the risk is on the loan side. And of course, if you set a capital ratio that's a couple percentage points higher, and even if we had a 19th century style bank that we were interested in, which we don't, that bank could just increase the riskiness of its loan portfolio or its other operations that would kind of make a small increase in the book value ratio kind of irrelevant. So as you can see, it's kind of strange that so much time, so much effort is spent over whether the capital ratio, book ratio, should be 5% or 3% or 7%. By the way, the right number is 10%, of course. So now, many bankers will say, well, these problems that you just mentioned, loss recognition, the irrelevance of tangible assets for most of the financial health of the banks, and the problem that banks can goose up risk to offset small changes in the capital ratio, you should just put all that aside because the large banks will show you that the spreads on their debt right now are not indicating any support value coming from too big to fail. That is, if I did a financial model that looked at debt spreads of the large banks, I could find a residual, possibly, that would indicate whether the banks were getting some, if the holding constant their capital ratios and other kinds of attributes of their bank, if I found that their debt spreads were very small relative to, let's say, smaller banks with those same attributes, I'd say, oh, that's that too big to fail subsidy showing up in the debt spread, right? But the banks point out that the current studies find no such subsidy. Well, that tells me that it may be the case that right now, given the risks that the banks have on their balance sheets and given the capital that the banks are holding, that the too big to fail subsidy is sort of what we call in finance an out of the money option. That is, it's not going to show up in the debt because right now that subsidy is not very important. It doesn't mean, though, that if things get bad in the future, that the future debt offerings by the banks in those kinds of circumstances won't include that subsidy. And that's one of the key things I want to point out, that a lot of the data that's being used to say that we've solved the problem is data based on today, but that's not the right test. We want to ask whether in bad times we're going to have that same resiliency, and I don't think the evidence is very helpful in answering that question. So what can we do? And here it's very nice to have Mark Flannery here because I think Mark Flannery was one of the first people to really be proposing this, and I've been supporting it with some versions of this proposal on my own. And I want to explain why I think, in addition to increasing the minimum capital ratio of banks to 10% of assets, because I do think that it's still a helpful tool, why what we need to do is something else that Mark has championed, and that I've been championing, which is to impose, in addition to that, a contingent capital requirement on banks. And this requirement would be a form of debt, again, about 10% of assets, I would suggest, that would convert to equity if the market value of the bank's stock, and I emphasize the market value, relative to assets, got below some particular threshold. And I would set that threshold very high, maybe about 10%, and I would make that conversion very dilutive of existing shareholders so that the CEO of the bank would want to avoid it at all costs. And how could the CEO avoid it? By issuing equity. So it's like an equity thermostat, a market value ratio thermostat, that when the equity ratio is about 11%, the CEO starts saying, well, I better go out and issue some more equity to push that above so that I don't hit that threshold. And so you never, assuming the CEO behaves that way, you never even get close to an insolvency point for a too big to fail bank. Furthermore, something else happens. The bank that's avoiding the insolvency is also setting the buffer, the total amount of the market value of equity over and above that trigger, setting it, of course, in light of the riskiness of the bank. So now we get real risk-based capital. That is, the bank is now internalizing the effects of risk because the bank has to set a threshold because he wants to avoid having to go to the stock market constantly to issue stock. And then, well, that also means that he's going to be managing risk better because he's paying the cost of risk. So what we've done by creating this flexible and market-based and high-value trigger, and I want to emphasize this is not a bail-in COCO. This is not something that's triggered as part of just near the liquidation of the bank. This is long before the bank is anywhere near insolvency, when the bank has obviously full access to the capital markets. Well, anyway, I'm not going to go through all the details of that, but let's just talk about why that would be such a good idea. First of all, it avoids the forbearance problem of relying on book value of equity. You don't have this unrecognized losses problem because market value is what's going to determine the trigger, not what some banker and supervisor can agree the book value is. Secondly, as I mentioned, there's an incentive now for the bank to maintain capital commensurate with risk, so that the banker will choose to be above the trigger to a certain degree, commensurate with the amount of risk that the bank has, and will manage the risk better accordingly. If, however, the bank gets into a severe problem, let's say like an Enron problem, an accounting scandal, so that you all of a sudden have a sudden decline in equity value and you can't raise equity, well then you'll have a massive conversion of 10% of your assets from debt to equity, which itself will stabilize the situation. All of this, of course, avoiding any sort of too big to fail bailouts. Finally, two other things. Notice that we really have to understand the Lehman crisis a little deeper than most of the analyses have. The Lehman crisis didn't happen in September 2008 because Lehman failed. Lehman was a match in a tinderbox. What Lehman did was signal through its problems that there were deep problems in mortgage-backed securities in many other banks. And the reason it was a systemic crisis is because that concern led to a freezing up of the interbank debt market, of the commercial paper market, of the repo market. Why, though? Why would those markets freeze up? Because if you look at Citibank, for example, Citibank's market value of equity in mid-2006 was about 13% of assets. It had fallen by September 2008 very gradually, to about 2% of assets. In other words, the insolvency point, because it can't fall much more than that. In other words, the market doubted Citibank's solvency. And then when Lehman failed, it had all the more reason to doubt it, which meant counterparty risk was very high, and the willingness to deal interbank was very low. So the reason that we had a systemic problem was precisely because the market value equity ratios of the largest banks were allowed to decline to effectively the insolvency point. And then we had a triggering event, but it wasn't that the event caused the crisis, it was that the event gave us further corroboration of the fact that these banks were all very weak. So if we can keep that market value equity higher, we also solve not just the too big to fail problem from a taxpayer standpoint, but we also solve the systemic risk problem. That's pretty good. Now, why not just regulate the market value equity ratio directly rather than use these COCOs that Mark and I and others have proposed? And the answer is simple. If you embody this trigger for the market value of equity in a contract between two parties, private parties, then there's nothing that regulators would do or could do to abrogate that. Whereas if you make it a market value of equity regulation in the clinches, they can change the regulations. And by the way, I wouldn't be surprised if they did. So I think that I'll stop there because I think I've taken up all of my time. But just in summary, let me just give a couple sentence summary. So Dodd-Frank did not really address successfully the problem of too big to fail, nor did, in particular, all the hope that we're placing on low, slightly raised book value equity requirements, or even higher book value equity requirements by themselves, I don't think would do it. The stress test is still, like the book value of equity requirements, part of this sort of balance sheet fetishism that we need to get beyond. And more importantly, when we do, using mechanisms like a new COCO's requirement, basing things more on market values, will find a way not only to avoid these problems, but actually to avoid the kinds of systemic problems that we came into during the crisis. Thanks for your attention.
Thank you, Charles. Our next panelist is Mark Flannery, Bank America eminent scholar in finance at the University of Florida. Mark was one of the pioneers, if not the pioneer, in developing contingent convertible capital proposals. He'll deny that, but we're going to go with that anyway. Since 2012, he served on the Federal Reserve System's Model Validation Council. Since 2011, he's been a senior advisor to the Treasury's Office of Financial Research. Since 2009, he served as an advisory committee member for the Federal Reserve Bank of Atlanta's Center for Financial Innovation and Financial Stability. And since 2006, he sat on the Federal Reserve Bank of New York's Financial Advisory Roundtable. He's also spent a couple of years. I wasn't going to say that, but he's also spent a couple of years as a resident scholar for the Fed at New York's research department, as well as spending 4 years as a co-director of the FDIC's Center for Financial Research. Please help me welcome Mark Flannery.
Thank you. Good morning, everybody. It's nice to be here. It's nice to have the opportunity to talk to you. I think you're going to get sort of a sweep here of similar answers about the question of Dodd-Frank, but I'm going to come at it from a different perspective. Okay, let me make clear first two things about Too Big to Fail. There's sort of the bang version and the whimper version of Too Big to Fail. The bang version is where there's explicit government support provided, and that comes almost always in response to an imminent depository run or a liability run, an imminent inability to fund the firm in the private market. There's another kind of too big to fail support, which is the kind of forbearance. If you have a firm that has a lot of insured deposits, it can keep funding itself basically as long as the insurance is credible, and yet the government letting the firm continue to operate inadequately capitalized imposes a contingent possible obligation on taxpayers and on the government. So there are really these two different versions, and we think a lot about what happened, in the wake of Lehman. But the dog that didn't bark so loudly is the one where there were a lot of firms that were badly capitalized and were allowed to continue operating without any particular change. Now, it's interesting that Charlie mentions the history of capital regulation, because I think the reason we focus on this so much is that in the 1980s, the Basel Committee banks, countries, there were 10 of them, got together and they said, we have to have an internationally level playing field. And that was code for keeping the Japanese from underpricing commercial loans and commercial lines. The trouble that the international community confronted was that there were a lot of institutional differences between the banks and the way they operated in different countries. Different powers, different permitted activities, different environments, different amounts of insurance or lack of insurance, formal insurance. So really all they were left with was capital adequacy. That was the one thing that they could apply to all of the banks. But unfortunately, they set the required minimum ratios, and this sophistication continues in terms of book capital measures. And book capital measures have a lot of managerial options in them. GAAP accounting, IFRS accounting, has a lot of managerial options that allow an overstatement of the value if it's in the interests of the firm to do that. And you can't do that without the acquiescence, at least, of the supervisors. But I'm going to come back to that, because that's a really important conflict right there. Well, another way to measure solvency is by equities market value, which takes into account all of the future cash flows, whether it's on book or off. Now, I've got a couple of papers that use a data set that looks at the largest 25 bank holding companies in the U.S. And this particular graph for 5 years before the crisis looks at the book value to total asset ratio on the vertical axis and the market value on the horizontal axis. So I'm comparing the two measures, book and market. And that line, that black line, is a 45-degree line. Doesn't look like the 45-degree lines you usually see because the horizontal axis is wider than the vertical axis is high. But if you look at the correlation between book and market values in the good times, then most of the time the market value is above book value. So each one of these dots is a bank year. And the correlation coefficient among these ratios is 62%. Pretty big number, clearly positive. So during regular times, it's conceivable that looking at book capital measures isn't such a bad idea in terms of assessing solvency. That's as a practical matter, not as a conceptual matter. Well, let's add 3 more years, the crisis years, and those are plotted here in red, and they look a lot different from the regular years in terms of the extent to which the loss-bearing capacity of the bank is measured the same way in book or market terms. And if I look just at the crisis periods alone, the correlation coefficient between book and market is now 22 instead of 62. So it's fallen a lot. And probably more importantly, the mass of points has shifted largely to the left. So in other words, the book capital ratios tend to be higher than the market capital ratios. And that's true for all of these individual firms, and I'll show you a picture in a minute that shows you it's true for the average as well. Now, in case you're wondering what those 3 points are way out to the right, that's American Express. They're probably a different kind of business. They wind up with a substantially different market value of capital ratio, and partly that's what Charlie said, that they're not just a borrowing and lending shop. They do lots of other things. Now, the trouble is that the market value determines the firm's solvency, or more importantly, it determines the ability of the firm to finance itself. So we have these large banks that fund themselves short-term and engage in liquidity intermediation, and they also, maturity intermediation. They also engage in liquidity intermediation, promising liquidity on the liability side and buying illiquid assets on the asset side. Now, the rollover decision for these short-term liability holders therefore becomes very important. Do I replace my maturing liability at the same firm? Well, it depends on whether I think it's solvent. Perhaps more subtly, it depends on whether I think everybody else thinks the firm is solvent. Because if I roll over and nobody else does, then I'm screwed. Because the bank has lots of illiquid assets, and they're not going to be able to pay back the deposit or the other liability that I just rolled over. So it's the market's assessment of solvency, or individuals' beliefs about other market participants' assessments of solvency, that's going to determine the ability of the firm to finance itself. Market values, book values don't matter. They don't measure loss-absorbing capacity. They don't measure the ability to repay. So here's a picture that I owe to Kevin Styro at the New York Fed, and I've used many times. He made it in 2010. The red dotted line, the red center line there, is the time series of book capital ratios from 2004 to the end of 2009. And if you just had that on the graph, you'd say, well, there was no crisis. Don't see any evidence. The blue line starts out high. That's the market value, the ratio of market value of common equity to total assets. That starts out high, and around the beginning of the crisis, it starts to fall. Now, this is an average of 18 large bank holding companies, the S-cap banks. And then the real trouble happens when the market value ratio has fallen quite a lot. Okay, so there are questions about the average firm solvency. The green line is the CDS spread, and it just repeats what the market value ratios are saying. But when the credit condition of these firms comes into question, that's when the trouble happens. It's true, in fact, it's even more true in Europe. If you look at the top 25 European banks, they've got the same phenomenon that until the crisis, they were pretty high, their market capital ratios. They started to fall apart a little bit sooner than the US banks did. But it was after the market value ratios fell a lot that we started to see a lot of bad things happening in Europe. Now the question, of course, is why doesn't anybody keep the loss-absorbing capacity of these large banks adequate? Not adequate in the sense of Basel, but adequate in sort of the layman's terms. One answer certainly is that the shareholders have very little incentive to issue equity when there's this big debt overhang, because a lot of the benefit goes either to the liability holders or to the government formal or informal insurance. So the shareholders, once their market value falls, the shareholders are not very interested in issuing more shares. So the question is, why don't the supervisors do it? In other words, why doesn't Pillar 2 of Basel work? And there, I think, we really have to have a good understanding of why it doesn't work. And I actually think that that's the main problem that is left out of Basel III and is left out of Dodd-Frank. One possibility is that the market value of these assets just collapsed. They just fell through an open hole. And there was nothing anybody could have done in terms of capital adequacy beforehand. Now, the paper I told you about looks at the history in the US and even more in Europe. It turns out that there were a fair number of banks that continued year after year to operate with capital ratios which, relative to their asset volatilities, implied a pretty high probability of default. Same bank this year, same bank next year, same bank the year after. In other words, I don't think it's just that in the event that we've talked about so much in the last decade, that the market value of these assets just fell through the floor and there was no time to react. There's certainly some of that. But mostly I think there's evidence the supervisors never followed up very strongly on Pillar 2. Now, why? An easy answer is capture. Are they captured? Maybe. I talked to a consultant who just moved to Europe, and I asked him what it was like over there with the supervisors, and he said, I can't believe how captured they are. Coming from the States, it makes the States look good in that dimension. So that's one possibility. I think another possibility, though, is the problem that you have with a lot of regulation, the problem that you have with a lot of policy, and it's not unrelated to making monetary policy credible. Monetary policy, the Fed, the Bank of England, the ECB have tried very hard to manage future inflationary expectations and try very hard to convince people that they will have the stamina and the tools to resist inflationary monetary growth. Doesn't work very well in this case for Pillar 2 kinds of interventions. And I think one reason is that if I'm a bank regulator and I go to Bank X and say, sell more equity now, the losers there, the people on whom those costs are imposed, are the investors, and they're very identifiable. And the bankers can always argue that now's a bad time to sell stock, and the price is depressed by these crazy short sellers. And you get into a lot of problems, particularly if solvency is questionable to begin with, as Charlie pointed out. The benefits of this action are pretty far dispersed. So you have the problem you have with a lot of lawmaking and a lot of regulation making is here in spades. So suppose the supervisors say, okay, I better be sure that I think you're undercapitalized. And since there's a lot of noise in all of these numbers, it's very hard to assess. The temptation to wait for more data is pretty strong, even if you had an absolutely upright, upstanding, uninterested in the revolving door kind of supervisor. And then the other thing that really is where the regulators have gotten themselves in trouble is the regs are all written in terms of book values. And so the banker can always say, if you look at my book capital ratio, I am more than adequate, more than adequately capitalized. So now the supervisors have to attack and discredit the accounting numbers. Not that they can't be done, that it can't be done, just that it's a long process. So I think there are a lot of delays built into this process, and even if you think that supervisors aren't captured in the typical sense, I think there are a lot of reasons to believe that this is an extremely hard problem to try to look at a bank that is continuing to fund itself and say you're inadequately capitalized and you should sell shares and impose losses on your current shareholders now. You hear a lot, and the TARP is a good example. You know, we had no choice. We had to support these banks because there was no other alternative. Well, what happens is that if you let bank capital fall gradually, and you let it fall to the point where the firm can't fund itself, then absolutely there's no choice, because at that point, the market believes the firm is insolvent, so you can't sell new shares. So your choice is to let the bank go through what was historically, and I think will continue to be, a messy reorganization, or you can pony up with some sort of guarantee. So I think that the problem we get to the last minute, the problem really needs to be addressed with supervisory discretion a long time before that. Okay, so now we have Basel III. What's different? Well, there's probably better quality capital. You know, the fact that they got, say, TRUPS out of the capital measure is a good idea. It doesn't fix the book valuation problems, but it makes them a little bit less important. You have to stretch the valuations a little bit more in order to reach the capital ratio. I think the CCAR is something of an improvement. It introduces a forward-looking kind of information set into the measures of the current capital, but there are no revisions to Pillar 2, none. So essentially, we have to believe that the supervisors are going to try harder, work harder, think harder, act sooner, and I don't see any reason to think that that's true. And so if we get to the question, can fixing capital requirements end too big to fail? I've got a simple answer, I don't think so. And I don't think so because of the fact that we're tied to book capital measures, and they're manipulable, and we have supervisors who are put in an extremely difficult position trying to take steps for the dispersed greater good when they impose costs on a limited number of people. Let me make one last comment. There's no revision to Capital II, and the role of COCOs, as I view them, is that it substitutes rules for discretion. It's just like the old monetary policy argument. We think supervision, we think supervisory discretion is not up to the task, then we find a rule that makes has a lot of good outcomes, even if it's not perfect. We don't say, are COCOs, is there anything wrong with COCOs? Sure. I can tell you a half dozen things that could go wrong with COCOs. The question is whether those things are better or worse in expectation than the things that can go bad with supervisory discretion. Thank you.
Thank you, Mark. We have one final panelist, and then after that, we'll have time for question and answers, and we'll have somebody coming around with a mic. So our final panelist is Mark Kupiec. He's a resident scholar in banking and financial market regs at AEI, American Enterprise Institute. Prior to joining AEI, Paul worked also for the FDIC. I was waiting to see if he was going to deny that one. He was an associate director of the Division of Insurance and Research within the FDIC's Center for Financial Research. In that capacity, he oversaw research on bank risk measurement, as well as development of regulatory policies such as Basel III. He has also served as the director of the Center for Financial Research at the FDIC, chairman of the Research Task Force for Basel Committee on Banking Supervision. He's worked at the International Monetary Fund, Freddie Mac, JP Morgan, and the Division of Research Statistics at the Fed Board of Governors. Welcome.
Thanks. Mark and I are often confused. We've worked together for many years. So let me just first say that amongst the gentlemen here talking about too big to fail, I uniquely am the only person that have worked at three SIFIs, the Federal Reserve Board, biggest SIFI in the world. I worked at Freddie Mac, and Mark also was a consultant for Freddie Mac, a very nice, large, failed SIFI, and JP Morgan, the most evil place in the whole entire universe, where all of us made billions of dollars, which is why I could retire when I was 16 and come and work for the federal government and then talk about policy. So that's what I'm going to do today. I'm going to talk about Dodd-Frank. Has it ended too big to fail? Thanks very much for inviting me, and it's good fun to be on this panel. So has it ended too big to fail? And if you're in a hurry, the short answer is no. But I'm gonna talk for my 25 or 30 minutes and tell you a bunch of other stuff too. But the basic answer is no. So first, I'm going to tell you a little bit about the Dodd-Frank provisions related to SIFI resolution. So there's two of them. There's Title I and Title II. And Title I is I'll tell you about it in a minute. The second thing I'm going to do is review the FDIC single point of entry resolution strategy, or the SPOE, because every new program in Washington needs an acronym, and this is the SPO, I guess. I guess that's how you say it. I'm going to talk about the goals and the restructuring transaction. I'm going to walk you through, actually, a couple of restructuring transactions, which I think is a new feature in the world, because I've never seen anybody do it. Okay, will the SPO solve the TF problem? They've got two acronyms in that sentence. That's a great sentence. No, it leaves the too big to fail funding advantage in place for about 90% of the SIFI liabilities, okay? So those are still going to be guaranteed. Derivatives, SIFI derivatives, a huge business for the SIFIs. They're going to be government guaranteed to prevent asset fire sales. So there's a new guarantee in this process. And the plan for recapitalization may fall short on funding and recapitalization needs, and I'm going to talk about that at the end. So the first Title I of Dodd-Frank is the largest SIFIs, bank holding companies bigger than $50 billion and other designated SIFIs, have to submit an annual orderly resolution plan to the Federal Reserve Board and the FDIC. And that's the first SIFI resolution title in Dodd-Frank. And the second one is Title II, which gives the FDIC authority to resolve systemically important financial institutions outside of bankruptcy courts. So there's an administrative procedure, and to do this, there must be an impending bankruptcy among one of the firms, and it must have serious adverse effects on the U.S. financial stability. That's what the Dodd-Frank law says. And the FDIC gets receivership powers over the SIFIs. They're very similar to the powers it has under the FDI Act, the Federal Deposit Insurance Act. So the first Title I is the orderly resolution plan, and all SIFIs have to file an ORP and a credit exposure report with the Fed and the FDIC. And it's supposed to disclose the ownership structure, so who owns the SIFI, the assets, liabilities, and its contractual obligations, all cross-guarantees tied to security. It's supposed to identify all its major counterparties and identify some process in place that they can use to identify counterparties holding SIFI collateral should they have to come in, at a moment's notice and shut the SIFI down. They want to know where all the collateral is. The orderly ORP regulatory process, how does this work? Well, the FDIC and FRB must review the plan and concur that it actually would result in an orderly liquidation. So they have the big shops have to provide a story that says how they're going to wind themselves down in bankruptcy court. The FDIC and the FRB have to read the story. They have to buy into the story and say, yep, we think that'll work. If they don't, and they haven't yet, to my knowledge, they've already done this twice, I think, the next time's coming up, they can require tighter capital requirements, liquidity, or leverage standards on the SIFIs if they don't approve of their plan. Or if it goes on long enough, they can require the SIFIs to change their organizational structure in a way that the federal regulators think would enable it to do an orderly liquidation. So there's a lot of second guessing going on here. After 2 years, if they can't satisfy the regulators, they can require SIFIs to divest businesses that they think are problematic. That's a pretty strong power. We haven't come to that yet, but I suppose it could happen. So now we're all going to move on to special resolution process for SIFIs, Title II. This is a special administrative process which happens outside of the courts. To do it, the SIFI must be in danger of default. It means it has to have some loss that makes it undercapitalized, or it has to suffer some inability to meet payments, be very illiquid, not be able to raise money. The FSOC must produce some description of the effect that the SIFI is going to have on the financial stability of the U.S. economy and on the stability of low-income, minority, and underserved communities. You got to have both those things. You got to present your case to the Secretary of Treasury, and you got to make a case why the bankruptcy is not the right way to go. We in the government are the only people that can do this right. We're going to have to take it into the FDIC to resolve it. The courts can't be trusted to do this without causing undue distress for the financial stability or low-income, minority, or underserved communities. The three keys to start the process. So it's just like in the nuclear silos, where they rigged the tests in the last few weeks out in Montana. Everybody's got to turn the three keys at once. And depending on what kind of firm is the SIFI, it depends on who has the key. So if it's a depository institution, it's the Federal Reserve Board, the FDIC, and the Secretary of Treasury. If it's a broker-dealer, it's the Federal Reserve Board and the SEC, and they have to consult with the FDIC and the Secretary of Treasury. So that's really kind of 3.5 keys. And the FRB and Director of the Federal Insurance Office in consultation with the FDIC if it's an insurance company. And the Secretary of Treasury has to make the recommendation to appoint the FDIC as receiver. And the SIFI has the right of judicial appeal, but this is kind of not really much of a right, because the standard that the court has to determine on, was this an arbitrary and capricious decision? That's the only way they can overturn it. That's a pretty low standard, I'm told. I'm not a lawyer. There are lawyers in the room. We can talk about that later. The court has 24 hours to decide. If they don't make a decision in 24 hours, it automatically goes into effect. If they reject it and say it's arbitrary and capricious, the Secretary of Treasury can fix the typos and send it right back in. So there's kind of no escape from this. They can keep doing that, right, until they've got you once they're in this process. There's no judicial stay on the process. So even if you're right and you have a good reason, they're going to take your company and they're going to resolve it. Now, you can sue them after the fact, but the company's gone. Once they have the company in the process, there's no reversing it. It's the same way with a bank. Once a bank is in the resolution process, you can't get the bank back. So the powers for the FDIC receivership are similar to the FDI Act powers. The FDIC makes a claim determination. It can decide that some contracts the firm entered into are burdensome, and it can say we don't have to honor those contracts anymore. It's going to establish a bridge financial company, or it has the right to. It has the power to pay claims out of that, and the power to pay some claims more than they might get in bankruptcy, if it makes the resolution easier to do. So what does the FDIC have to do under Title II? It must liquidate the company, okay? The SIFI shareholders can't receive any payment until everybody else is paid in full. Unsecured creditors have to bear the losses, and there has to be a priority of claims that make sense. Managers and directors must be removed, and the FDIC must recover all taxpayer funds used to facilitate the liquidation. So there's no taxpayer money that's supposed to go into resolving a SIFI. The FDIC is prohibited from taking any equity interest in the failing firm or any of its subsidiaries, so they can't put equity capital in it. They can't use taxpayer funds to prevent it from being liquidated, and they can't impose any loss on the taxpayer. So the FDIC receivership tools, it gets some new tools, okay? The new tool is it can take a bank holding company into receivership. It never could do that before. It could only resolve bank institutions, IDIs, insured depository institutions. Now it could take bank holding companies. Now, one of the reasons before that bank holding company capital that Mark talked about, and I digress for a second, is that there was no enforcement power. The Federal Reserve could not declare a bank holding company bankrupt. It was a corporation. The Federal Reserve could say it had to have a capital requirement, but it couldn't force them to raise capital because the Fed did not have the power to declare a bank holding company insolvent. It could put cease and desist orders and stop them from doing business. But there was one famous bank holding company, Tanis, was the holding company for Deutsche Bank in the U.S., which had a negative capital ratio for years, and they didn't do anything about it. I don't know how you have a negative capital ratio, but that's what all the people that look at these things tell me. I never could quite figure out how that could work, but they did. And so there was really no enforcement power. The enforcement power in banking is on the depository institution, and it comes from prompt corrective action, which was under fiducia, right? That's when that was instituted. If you're undercapitalized, the FDIC can come in and close you, okay? If a bank holding company is undercapitalized, the Fed cannot go in and close them down. It's just not in the law. Now it is in the law, okay? Now if a SIFI is undercapitalized, or if a bank is undercapitalized and the FDIC determines, and the Secretary of Treasury and the other keys determine that they need to take down the holding company to resolve the bank, they have the power to do that. So now the big change in the law is bank holding companies can be put into the government receivership process. That couldn't happen before. That's why they could have capital requirements anywhere, and essentially they could make a lot of noise about it, but nothing happened. Well, the new tools that the FDIC has is it can use this orderly liquidation fund power to fund the SIFI receivership. When it immediately takes it into receivers, it's got a limit of 10% of the consolidated assets of the SIFI that it can pledge with the Treasury and get a loan of up to 10% the value. Now, once it does a full valuation of all the assets in the SIFI, the Treasury says, okay, we'll let you borrow up to 90%, but that's going to take months, okay? It takes months to value a very big and complicated enterprise. Immediately when it's taken into the resolution process, 10% of the SIFI assets, and those are going to be book value numbers. They're going to be bad book value numbers like Charlie was talking about, but that's the limit. There's clawback provisions. If people made money before, executives or directors, you can go back and try to claw that back, and then you can ban people from the business of banking or whatever. Now, the Dodd-Frank didn't tell the FDIC how to do the resolution. So this new thing is an FDIC proposal, their strategy for how they're going to do a SIFI resolution. It's called the single point of entry. So the FDIC has essentially adapted its bridge bank receivership process, one that it's used before many times before on banks alone, to resolve a SIFI. So it's really just a little bit of a tweak of stuff they've already done. Now, what they're going to do is they're going to take, or they say they'll do, is they'll take the top tier bank holding company, So the bank holding companies have many holding companies underneath them, and my own banks directly, or the holding companies under them might own the banks. They're very complicated structures. If any of you ever looked at this, you know that. But they're going to take the top holding company into a receivership process, and they're going to work from the top. So they're going to take over the parent. They're going to impose the losses on the parent debt and equity holders. They're going to charter a new bridge bank, and that's going to be the new parent for the bank holding company. And the bridge bank is where all the stuff is going to happen. Okay, so they're going to leave debt and equity issued by the parent in the receivership, so that's who's going to bear the losses. And they're going to use that debt and equity somehow to fund the new bridge bank. And I'm going to talk about that at length here in a couple of minutes. They're going to fire the management. They're going to hire a new management. They're going to decide to move some claims into the bridge bank. They might be able to treat some claims differently if it makes their life easier. They have the right to do that under Dodd-Frank. Now, the main point of doing it this way is they want to keep the subs of the holding company open and operating. Okay, so all the subsidiaries under the top holding company are going to be transferred to the bridge bank and kept funded and open and operating, and the claim is that avoids systemic risk. So they're going to take all the derivative claims and transfer them to the bridge. This prevents derivatives, which if there's ever a bankruptcy and your counterparty declares bankruptcy, the derivatives immediately wind up. So if there's collateral against the derivative position, everybody grabs the collateral, they sell the collateral to satisfy it. That happens right away. So the FDIC is going to transfer the derivatives claims to the bridge bank and honor them all. Then they're going to say they're all safe and solvent. The derivatives are not allowed to close out then. So it's essentially a way to put a stay on the closeout in the derivative contracts. It stops the fire sale of assets is the intention of that. The FDIC is going to keep the subs open and operating to avoid market disruptions from the subsidiary failure. So the whole idea here is when the subsidiaries fail, that's what caused the market's disruption. When the holding company doesn't really do anything, it's a shell, right? It's all the subsidiaries that do all these important market functions, and the story being told here is the real problem with systemic risk is if any of these subsidiaries cease to function and operate, the market will lock up. Now, you may or may not believe that. I personally don't believe that, and others don't believe that. But that's the story here. So we're going to keep all the subsidiaries open and operating, and that's the goal. Now, I worked at the FDIC for 9.5 years. I'm going to tell you the real story why they're doing this, okay? The real reason to keep the subs open and operating is the banks frequently depend on their affiliate operations to run the bank. And the FDIC found this out the hard way, okay? When you close some kind of banks that do sophisticated stuff, you might have the bank. It might have all the deposits. It might issue. It might do stuff. But all the processing for things that are done in the bank might be done in an affiliate. So you might do all your bookkeeping for the deposits in an affiliate of the bank. It's not in the bank. It's a different part of the holding company. Why would you do that? Because then that affiliate can do processing for other banks too. So they can have a business of doing deposit processing or for credit card processing, that kind of things. The FDIC ran into this problem in 2002 when it closed Next Bank, which is a small subprime credit card lender, and it closed the bank. And it abrogated all its contracts. Well, one of the contracts was with the processor that processed credit card claims. Well, pretty soon it had a bunch of credit card claims that it couldn't do anything with because it fired the processor. And then the processor went out of business because that was the only contract the processor had. The FDIC had to go out and find somebody else to process the credit card transactions. And they said, oh my gosh, this is a horrible problem. This makes it real expensive. And they got taken to the woodshed for not knowing how to do a resolution of a complicated job. So their solution was, really what we need to do is we need to get new powers where if these things are spread all across the holding company, we need to be able to take the holding company down. It just makes our life easier. We'll just take it all at once. We won't have this problem again. Well, they did that in Dodd-Frank. They got that in Dodd-Frank. So that's essentially, it's not like they didn't face this problem before. They faced it when they resolved depository institutions. So they're going to keep the subsidiaries open and operating and funded. The bridge bank is going to function as the new top-tier holding company. All losses are going to be imposed on the top-tier holding company equity and debt. We're going to get rid of management. And we're going to fully recapitalize the bridge bank and make it self-funding using customary sources as possible. So the bridge bank is supposed to use the debt and equity in the parent to restructure itself so it can fund itself in the capital markets in a normal way. Now, the FDIC says we might have to guarantee things for a while. We can use that 10% right to go to the Treasury and borrow from the Treasury with collateral if we need to do a guarantee. So maybe we'll do guarantees and it'll be backed by this 10% guarantee. And the bridge bank, before it's all done, is supposed to be reorganized in a new way, so when it comes out of this process, it could easily be done in a bankruptcy. So they're going to reorganize all these really complicated shops in, I think their timeline is like a year or year and a half, they plan on having it. So we've already had the living wills for 2 years, and they haven't reorganized, but as soon as we get it into the FDIC, 6 months, 8 months, we'll have it all reorganized. Well, and that's in their paper, actually. That's their timeline. Will the SPO solve the too big to fail problem? The implicit government guarantee what is the too big to fail problem? Well, it's not just that if the institution fails, somehow the markets can't function anymore. The too big to fail problem starts the way Mark and Charlie are talking about is there's an implicit government guarantee that makes the SIFI debt too cheap, right? Investors don't price in the risk. They think they've got a guarantee. It encourages them to take risk to maximize the value of the put option, right? And they maximize their too big to fail subsidy. So how does the SPOE fix this? How's it going to fix this? Well, first, they're going to move all the derivatives into the bridge bank to keep the derivatives from closing out, seizing assets, and selling them and causing fire sales. That's what they say. Well, that essentially guarantees that no collateral is seized and sold. It avoids the fire sales, but it guarantees every SIFI contract, right? So if you have a SIFI derivative contract, derivative contract, better have it with a SIFI, because then your derivatives are just going to go to the bridge bank. They're going to be guaranteed. You're going to sail right on. You don't even have to worry about counterparty risk anymore. They're going to be covered, right? That's what it says. SIFI derivatives book. The FDIC, I already said that, right? No collateral seized and sold, but the guarantee, removes the SIFI credit count. We already said that. SIFI implicit government guarantees. That we're going to impose the losses on the debt of the top tier SIFI holding companies. Some debt claimants may be protected. Maybe all of those guys won't be imposed losses on. Some of them we might actually have to protect to keep the company open and running. But all the subsidiary debt is going to be guaranteed because it's going to be moved into the new bridge bank because we have to keep those guys open and operating. Well, the problem is if you look at SIFI balance sheets, 90% of the debt issued by SIFIs is issued in the subsidiaries. It's not issued at the holding company. It's about 10% of the debt is issued at the holding company, which, by the way, is Charlie's number. He wants 10% in COCOs at the holding company level, but Charlie, 10% is not enough. I'm going to show you in some slides. It's not enough to have. Okay. So about 90% of the SIFI debt and the entire SIFI derivatives book is now guaranteed by the FDIC's SPOE transaction, which is what they say, right? Does that sound like it's got rid of the too big to fail guarantee? Maybe not to me, right? There's no guarantee that the debt to equity conversion at the top tier holding company will produce enough resources to attract the funding to continue SIFI operations and provide the needed recapitalization. And what we're going to do here is we're going to look at a couple of SIFI financials and see how this is supposed to work. And I think you'll see the issue I'm talking about. So here's the SIFI structure for Bank of America. And I don't know if you can see on the screen, but to do this, you have to go to the bank reports, which are the call reports on the individual institutions. Those are at the FFIEC website or the FDIC. Then you have to go to the Y9C consolidated reports at the Federal Reserve, the holding company reports. And so you can see that the Bank of America has 3 depository institutions, 3 separate insured depository charters. One of them is very large, right? The one in the middle, B. That's most of their stuff. Another one is a credit card, and I forget what the third one does. But most of the deposits and most of the activities in one insured depository institution, right? Then you've got the consolidated assets for the holding company from the Y9C, which is like $2 trillion. And so the bank's share of that is about 77%. There's a number up there. And you have some consolidated equity in the whole institution. But then there's the parent only. That's the top tier holding company. That is the holding company that the FDIC is going to seize and use the equity and debt to cover. Okay, and for that one, it's much smaller. There's some ratios down here. The parent assets, the parent holding company's assets over the consolidated holding company assets are about 21.8%, right? The parent's equity over the consolidated assets is only 11%. So, and you can see that there's some ratios there. The parent liabilities over the parent equity over the largest IDI assets is 16%. So what we're going to do is we're going to use this small sliver at the top. That's where the losses have to come from. That's how we have to restructure things. And if I can get this to move again. Okay, so yeah. So what would happen if there were a large loss at the largest IDI and it left the largest bank undercapitalized. Well, I'm going to hit poor Bank of America, the biggest bank, with a $120 billion loss, okay? Now, if I do that, the numbers in the last sheet change to the numbers here. So if we were to go back, and I think I can go back, right? We had a capital ratio, an equity to asset ratio at Bank B of 12.5% when we started. And after I imposed this loss, which is a healthy capital equity ratio, after I imposed the loss, we're down to 4.5%. Now, since this is a SIFI, this has got to be 6% under the new Basel rules, right? Under the new Basel leverage ratio rules. And so now this one is undercapitalized. The holding company here, though, I think, in the green, the holding company is above 5%. So the new SIFI leverage requirements, just come out from the Federal Reserve a month or so ago, right, is if you're a SIFI, the bank holding company consolidated leverage ratio has to be above 5, and all your IDIs, all your depository institutions in the holding company have to have a ratio bigger than 6. We just took a loss in Bank B. Its ratio is now 4.5. Okay, that's undercapitalized. If we don't do something about it, the regulators have to come and take that bank away. But they're going to argue that we can't resolve that bank unless we take the whole holding company down, because there's everything else in the holding company helps us to run that bank. So they're going to make that argument now, and they can make that argument. So let's see how they would resolve this, or let's see how it would get resolved under the SPOE. Well, what you would do is you would see that the bank is undercapitalized, and we'd look at the structure of the parent company's debt. So if I look at what debt the parent company has outstanding, I can see, well, subordinated debt, I've got, what? I left out the commas here. So $2,417 million. Did I get that? No, it's $24,177,000,000. When the numbers get this big, they get hard to read. So I got that. So if I'm going to take this and do it in a SPO, what I'm going to do is I'm going to take that sub debt, I'm going to move everything into a bridge bank, and I'm going to impose the losses on that class of creditors, those sub debt holders. I'm going to take them all out, and I'm going to keep all the other debt, and I'm going to move it to the bridge company. So I'm going to guarantee all the other debt in that parent, but I'm going to use the sub debt and impose the losses, and the equity guys are going to take the losses. So the new bridge bank, after the losses, is going to look like this. I'm going to change. I had some equity in the bank, right? And I changed that sub debt now. I'm telling those sub debt holders, I'm not paying you anymore. You now have you essentially have equity shares in the bank holding company. So now I've got this much equity in the bank holding company, right? So my new bridge has the smaller assets after the loss. It's got the same liabilities that, well, we wiped out some of the liabilities, and we changed some of the liabilities into equity. We had a little equity. I could go back in the slide, but it'd be too complicated right now. So I've upped the equity, but I still haven't fixed this problem. So the next step in the SPOE, okay, I cross out the sub debt. I end up, making liabilities smaller, equity bigger, the consolidated assets go down, or the consolidated liabilities go down, sorry. So the bridge now is going to sell $25 billion in new equity. So if you go back and you look at the bridge now has a parent equity over consolidated assets. It's over 6%. It's 6.9%, right? So I have room to raise leverage, right? I wiped out a bunch of debt, and now I have room. I can actually sell more debt, presuming the market will buy it. So what I do is I sell $25 billion in new debt from the bridge company, and if I need an FDIC guarantee, I'll have to get one. But hopefully the market will take this and believe that I'm good for it. Then I'm going to take that $25 billion and immediately downstream it to Bank B as new equity. So I take the proceeds and I send the $25 billion in cash to Bank B, and it gives me $25 billion in new equity at Bank B. And lo and behold, I've restructured it, and I wiped out the sub debt. I've got bridge company. I got rid of the management. Now I've got a solvent. All those banks are solvent. The bridge company is solvent. And now I can go and sell this bank, and I can just remarket the shares. It's a new, perfectly okay bank, and that's what we do. We'd sell it. We might break it up. We might sell it. But it's all recapitalized. Everything works good. This is the ideal. This is an ideal example, right? There was a loss in a bank, but it wasn't too big a loss, okay? So, and what I want to say here is, Mark Mark and I go way back on COCOs, way back to when we both worked at a too-big-to-fail firm, Freddie Mac, when we talked about them. But this is just like a COCO. It's not called a COCO, but the government comes in and it converts whatever shares here it is to equity when it wants to. So it's a COCO with a completely ambiguous government trigger. When's the government going to come in and close it down? So this is a COCO where I expect the risk premium to be even bigger than COCOs that had terms that I would know about, because these are just COCOs. The government can come in and say, you know, you thought you were a debt holder, you're really equity. Sorry about that, right? So that's what happens. Okay, so let me see if I can get going. So, okay, so when you increase debt, you have to sell debt, you know, somewhere in here. I already crossed out sub-debt, and I'd have to issue some debt in the market, and one of those things would change and go up. That was a best case example. I'm gonna get to the, here's one that's not so easy, right? Here's Wells Fargo. So Wells Fargo has more banks, okay, and it's got one particular bank, Bank D, and I probably have that highlighted, yeah, that's really the biggest shop, right? And it's well capitalized, 10%, but it's far and away the most important depository. So what happens if that takes a loss? So let me have the largest bank take a 10% loss that completely wipes out its equity. Well, that bank is now undercapitalized, but wiping out that bank's equity, since it's such a big share of the holding company assets, also wipes out the holding company equity. Remember before, the holding company had above the right 5% equity, right, in the last time? Now we're below, we're at 2.5%. Now we're really in trouble. We're below the equity leverage requirement, and we've got our major bank, the biggest bank, is now got no capital. We got to restructure this, right? So this is a lot worse case. Now, if we look at the Wells parent debt structure, so this is the debt in the parent, well, we look at this and we say, well, if I were to wipe out the debt, I might be able to get away with restructuring this, but I've got almost $21 billion in debt that the parent owes to the affiliates. Well, I can't wipe that out. If I tell all the affiliates I'm not going to pay back the money I owe them, well, they're going to be, I got to leave that debt there. So you got to look at the debt stack and figure out who you can wipe out and who you can't. Well, you can't wipe out that $20 billion 902, because that would cause you more troubles in the affiliates, right? You'd be causing them to go bankrupt. So I'm going to execute the SPOE, and I'm going to convert all the debt except the part that goes to that I owe to the affiliates. And when you do that, here's what the new bridge bank looks like. So I cross out all those debts except for the last one, and all the numbers change accordingly. So I still haven't done anything up here. I just restructured the bridge bank equity, assets, and liabilities. And so now I have way fewer liabilities, and my bridge bank has a very high equity to asset ratio, right? Because I wiped out all the debt at the parent. So now what I got to do is I got to figure, can I go to the market and sell a bunch of new debt? Now remember, I just wiped out all the debt holders. I've got to go to the market and convince people to buy debt in the bridge company, because I'm going to have to turn that into equity and downstream it to this bank that doesn't have any equity. And it's going to be touch and go whether I have enough financial capacity to do it, right? Well, it turns out here I do. If you believe you can sell the debt, I would need to sell $79 billion in new debt and downstream it to Bank D as equity capital, and that would bring Bank D up to snuff, right? Then that would meet the capital requirements just barely, 6%. And I would still have a high enough parent holding company over assets. So I can just squeak by. If the loss were much bigger, I wouldn't be able to do this anymore. I'd be short resources. The other problem is I haven't talked about a run. Well, when these banks get into problems, the liabilities run. And you either have to sell assets to meet redemptions on the liabilities if the Fed's not going to let you use the discount window, or you have to issue new liabilities to replace the runoff liabilities. So I'm going to be quickly in a situation, in a real SIFI, where I have to not only issue new funding to replace and recapitalize, I'm going to have to issue funding to replace the deposits and the wholesale money in the affiliates that's running, right? I'm going to quickly come up to this 10% limit that I have. I haven't been able, I don't have any time to do a evaluation of everything in there. If the Treasury is going to be tough about the 10%, the FDIC could guarantee funding up to 10%, but that's going to come into force fairly quickly if one of these large IDIs gets in trouble. So if the loss were water, we'd have trouble replacing it. I think I just told you all that. So let me just wrap it all up. The SPOE doesn't solve the too big to fail issue. It extends new guarantees to the derivatives book. Now, in reality, does it extend a new guarantee? Well, maybe not, because the FDIC always moves the derivatives book now. They've never taken it where they look at every derivative and say, oh, we're going to cover this one, we're not going to cover that one. They just take the whole book and move it. So practically speaking, they've written down what they always do. They move the derivative book. Okay, so you're covered. It extends the guarantee to about 90% of SIFI liabilities, which means there's about 10% of the liabilities in the holding company, which Charlie's number, which I'm saying isn't big enough. I don't think that's a big enough number.
Well, just to clarify, this has nothing to do with my proposal.
No, okay, but, all right. This is not Charlie's proposal, but earlier he said 10%.
10%'s enough if you have a completely different structure of regulation.
Okay,
than this,
okay,
maybe, right?
okay. You get a recapitalization accessible without taxpayer injection. So, you know, if there's losses that are sizable and taxpayers run, it looks to me like you're going to have a taxpayer injection to recapitalize things. They're going to have to use SIFI money to put money in before they can sell it. If it's a sizable loss, unless, and remember, these holding companies have not restructured themselves yet to take advantage, to react to the SPO. The SPO has just been announced. These are their existing structures. They got plenty of smart lawyers and way smarter people than me that are going to look at this, you know, with big magnifying glasses, and they're going to change their structure to make it harder to, you know, so the SPO doesn't work. That hasn't even happened yet. So if the losses are not contained and runs are not a big problem, it might work. The other thing I would point out is, for the SPO to work pretty well, just like I think Charlie and Mark said, you've actually got to put the thing into resolution while the holding company still has positive equity capital, right? You've got to go in and take it away from the shareholders while it still has real capital, or else the losses are going to be too big. Once the losses in the subsidiary wipe out the capital in the holding company, you don't have enough resources anymore unless there's an injection. And I think this is problematic, because I don't really think people have realized the property rights issues that are going on here. These were corporations that weren't subject to seizure, and the debt holders had to petition for the bankruptcy process or the management, and now the regulators can come in and you can have 4.5%, 3%, whatever the number is, equity showing on your books, and the regulators can say, it's the game's up, you're a systemic risk, sorry about that. So I'll leave it at there. Thanks. I'm sorry if I went over.
Thanks, Paul. Okay, guys, we do have time. Oh, thank you. We do have time for some questions, and if anybody wants to, please just, there's one in the back, Alex. Just say your name and affiliation, if you would.
It's,
Can't hear you.
I don't think Mike's on.
Is it on, Alex?
Maybe it's recording even if we're not hearing.
Brian Beery, Washington correspondent, Europolitics newspaper in Brussels. There's a lot of debate in the EU obviously on the Basel capital adequacy standards also, and this sort of narrative I hear a lot is that Europe's banks continue to be less capitalized than American banks, and I just wondered what's your view and position on this?
I resigned in November from being affiliated with the European Systemic Risk Board, so I can now speak freely about these issues. As you know, the ECB is going to be doing its stress test this year to try to figure out where the remaining holes in undercapitalization of European banks are. My own feeling is that the holes are fairly big, and that the ECB is not going to, because of political constraints on it, to really be able to identify those holes. To give you a quantitative answer, Acharya and Stefan have a paper analyzing the European, what they think the answer should be for the European stress test. And they estimate that the total amount of undercapitalization for any reasonable stress test is going to be somewhere in the neighborhood of 300 to maybe 600 billion euros. Of course, as you know, the fiscal support for the stress test is limited to a maximum of about 60 billion euros right now. And so most people believe that the ECB will end up concluding that somewhere around 60 billion is going to be the number that's needed. So I think that that's really a metaphor for the broader problem in Europe, which is the notion of a European banking system is really a fiction, a fairy tale. Europe is a set of nation states. And those nation states aren't very interested in recognizing loss right now.
I spent a fair bit of time working in Europe on banking systems for the IMF, including recently in some of the troubled countries. And the reserving standards in Europe they rely on accounting and reserving standards, and they can project that, someday in the infinite future, 28% of all mortgages in Ireland, for example, are delinquent, have been delinquent for 2.5 years. They haven't made any payments. But we still carry them on our books at 50, 60% of value, because someday, the write-off's way in the future, we're going to collect it. You can't do that in America. The regulators make you write stuff off much more quickly. There's a lot more latitude in Europe to keep bogus valuations on under book value accounting standards. It's just the truth. I've seen it in many places.
And let me add one point to that. IFRS versus GAAP makes banks look bigger. And so it makes the raw capital ratios look smaller. That doesn't mean that I think the European banks are adequately capitalized. I think they're desperately inadequately capitalized. We do have to be careful not to look at the sort of headline numbers and make that comparison across the Atlantic, because the accounting standards are different. If you look at, I had a couple of slides there that showed that before the crisis, the big U.S. banks had market equity to asset ratios around 20%. During the same period, the European banks had ratios of about 8% on market value terms. So I think the average asset in Europe is probably still worth less, probably more less than it was before the crisis. So I think it's pretty clear that they're undercapitalized.
Hi, I'm Sheila Greenwood with Prudential Financial. I was just curious if any of you have given any thought to the non-bank SIFIs who have been designated and the capital requirements that will be put onto them. Specifically, obviously, we're an insurer, and our business model does not really fall in line with bank capital standards. And we're just curious what you think about that.
That was part of the controversy that I alluded to at the beginning. The Senate and the House don't seem to be able to agree on whether those are supposed to apply to you or not, and the Fed's kind of in the middle. I don't know what's going to happen. I can tell you what I think, but I don't know. I don't know what's going to happen. I don't think that they should be applied to the bank capital requirements should be applied to other financial companies such as insurance companies. I don't think they were designed for what you guys do. That doesn't mean that they're not about to get applied to you, though.
Yeah, I would say it's way beyond that. Not only does SIFI designation bring bank-like regulation in terms of capital, but in the designation for Prudential, one of the things that the FSOC said was, all these insurance, they're all state chartered, they're all ring-fenced in the state. We couldn't possibly put that through our single point of entry a resolution system, so we think they're a risk. And of course, the dissenting opinion by the insurance regulators was that, well, this system has worked really well for 150 years. We really haven't had a problem. Why do you think our state-based, separate insurance, we don't believe your statement that it's a problem for systemic risk. We think it's a benefit. And so everything about this SIFIC designation, so far as it's been thought out by the authorities today, is bank-centric regulation, bank-centric resolution. They're only thinking one way, and asset managers, insurance companies, different business models, different capital, different accounting, different risks, different people who bear the risks. None of this has been, that I've seen yet by any regulatory papers, pronouncements, none of this has been sorted through in any way that's satisfactory.
So I want to take a different approach to answering your question. So first, let's separate the SIFI question from the question of whether we think the insurance industry needs to be regulated better and more. So just the SIFI designation, the way I read the SIFI designation is you should be designated a SIFI if there's some special likelihood that the government's going to bail you out. I think that's the logic that's at the heart of the SIFI. And I think it is true that there are two reasons why a government's likely to bail you out. Assuming you're big. If you're small, of course, you're not going to get bailed out no matter what. But if you're big, you'll either be bailed out because you have lots of short-term debt and contracts with people that could create a source of systemic problem. That's not going to be the insurance company's story. Although back in the 80s, when GIC contracts were used a lot more, you might have made that argument, and there were some real issues about that. What about just the fact that populist politics will make you bailed out? Well, now we got something that might be relevant for some of these life insurance companies that are doing very, very questionable variable annuity pricing, that have life insurance contracts. After all, I think we did just bail out a big insurance company, partly because of that. So I hate to say it, but I do think there's a motivation for very large life insurance companies maybe to be treated with this special designation. I'm not advocating the SIFI approach or the FSOC or any of that other stuff. I'm just saying there's a logic there that might apply, although it's not coming through a banking channel, it's coming through this populist politics channel. It's not about systemic risk, it's about political risk. Then now more broadly, I'm extremely worried about the life insurance industry right now. I think it is the locus of my greatest concerns in financial intermediation at the moment. Every asset class that I've looked into, when I look at why there's this overpricing happening, it looks like life insurance buyers or lenders are driving a lot of it. Commercial lending is a big concern right now. I can get terms as a small fry commercial real estate borrower that I've never seen in my entire life, 20-year fixed rates with very high loan-to-value ratios and no recourse that are unbelievably small spreads. And I think the insurance companies are pushing on that margin. Even agricultural land they've gotten involved in, and of course variable annuities. There's a paper by some people at London Business School called Shadow Insurance right now that's looking at some capital arbitrage that insurance companies are doing through some state laws in Vermont and South Carolina. That's very troubling. And of course the big problem is they have safety nets. They have these state level safety nets that do create perverse incentives. So I think that we have some serious issues in the regulation of insurance companies that we need to rethink that transcend this whole SIFI issue.
We have anybody else?
Mike Sonokor, Congressman Garrett's office. What's interesting to me about the whole Dodd-Frank seems to be that in one sense we've taken very prescriptive rules and put on the banks, and then in addition we've kind of said with the wind down, if you violate the spirit of these rules, we will take action as well. And my understanding is that if you look at the British system, it's historically been very spirit-based, whereas the U.S. system has been very prescriptive-based. But there's never really been a system that's had both so intertwined before. Does the United States, with the changing market, need to move to a more spirit-based system or keep the kind of prescriptive base we've had in the past?
Somebody else want to take the first crack?
Well, when you get down to it, there's a big issue when you allow huge regulatory amounts of regulatory discretion of property rights. So, for example, 15 years ago, when I was at the IMF, we were doing financial stability assessments where we would go around, and I'd spend a lot of time in Europe and Finland. And in Europe, and in Finland in particular, the case in Scandinavia, the law had to be, it was a very bright line law. The regulator couldn't do anything unless the capital ratio fell below 8%. That the bank, once you met the minimum, then the shareholders of the bank had the rights to run the bank whatever way they wanted to, and if they violated the bright line, then the regulator could do something. But if it wasn't above the bright line, back then, the American version of prompt corrective action was, well, this isn't so good, right? The regulator should be able to jump in early and prompt, corrective action before it happens, and you start at a different level. And that was like circa 1989, right, or 1990s, that's when we started doing that. But now we've gone to this other level where the regulators have huge discretion to influence the business decisions of virtually of many shops, but the very large shops. The stress test, as Charlie mentions and Mark thinks is okay, but it's a way to test accounting numbers. You run a scenario ahead, but there's a huge amount of interpretive judgment. Our ability to model what happens when macro scenarios go forward is horrible. The R-squareds, if you know that, and the percent of the variation in volatility in series like P&L that we can explain is way less than 20%. So 80% of what can happen is unknown. 20% may be explainable in a scenario, and yet the regulators can look at that and say, we think you're not running your business very well. You can't pay out money. Well, if safety is all you value, that's great. But I mean, if there are property rights for other ones, and individuals who invest in the bank, and the managers have to be able to run the bank. And now we have gone very far into giving a huge amount of discretion to the regulators. What happens if they exercise this discretion, and they are? And what happens when a bank fails? Whose fault is it then, right? Is it then the regulator's fault? Will they ever let a bank fail? Because they're essentially on the board of directors. No, you can't make payments. No, you can't invest in that. Our stress test says it's too risky. I mean, it's how far do you want that system to go, and then who's responsible? So, then once it fails, we make the shareholders and the debt holders and the top tier bear all the losses, but the regulators made all the decisions and approved it. So it gets a little dicey, I think. It's just my opinion.
Well, I think that the argument for the principles approach is always along the following lines. If you lay down exactly what a rule is, someone can get around it more easily. And so that might make sense, but it all depends, and I think this is consistent with what Paul said. Well, what are the incentives of the person who's regulating and supervising? And, it might be that you can empower people with principles rather than the strict rule to prevent this kind of regulatory arbitrage, but that only works as far as their incentives and the quality of their information goes. And I think that's where I very much like Mark's discussion of, really part of what we want to do is create regulatory systems that are a little more immune to the discretionary powers of supervisors and regulators. So I don't think this is kind of the big issue, the extent to which we're going to get supervisors to be empowered by giving more of a principal approach. I think that the problems are deeper than that.
Thank you, guys. That wraps it up for us. Thank you very much for coming, and we'll hang out here for a few minutes if you wanted to talk to anybody up on the panel. Thank you very much.
Thanks a lot. This is a very fun panel.